Today we are looking at Molson Coors Beverage Company, one of the largest beverage producers in North America with a long history in the global beer industry. Molson Coors primarily makes money by producing, marketing, and selling beer and malt-based beverages to retailers, bars, restaurants, and distributors. The company's revenue is driven mainly by branded beer sales, with pricing power tied to brand strength and consumer loyalty. Its portfolio includes several iconic beer brands such as Coors Light, Miller Lite, Molson Canadian, Blue Moon, Carling, Keystone. In recent years, Molson Coors has been working to diversify beyond traditional beer, expanding into flavored alcoholic beverages, hard seltzers, energy drinks, and non-alcoholic beer as consumer preferences evolve. Geographically, the company generates most of its revenue from North America, with an additional presence in Europe and selected international markets. Overall, Molson Coors operates in a mature and competitive industry, where scale, distribution, and brand recognition are key drivers of profitability and cash flow. Let's now look at the key risks Molson Coors is facing today, looking forward into 2026 and beyond. The biggest structural risk is declining beer consumption, especially among younger consumers. Beer volumes are slowly shrinking in developed markets as consumers shift towards spirits, ready-to-drink cocktails, and non-alcoholic alternatives. This puts long-term pressure on volumes and pricing power. Another risk is pricing pressure. Retailers are more aggressive with promotions, and consumers are increasingly price-sensitive, limiting Molson Coors' ability to fully pass higher costs onto customers. Input cost inflation remains a factor. Costs for aluminum cans, barley, energy, transportation, and labor are volatile and can negatively impact margins if inflation returns or stays elevated. Molson Coors is also exposed to brand and reputational risk. In today's polarized social environment, marketing missteps or public controversies can quickly affect sales and brand perception, as the company has experienced in recent years. Regulation and taxation represent ongoing risks. Alcohol producers face strict advertising rules, higher excise taxes, and tighter health regulations, which can limit growth and profitability. Finally, competition is intensifying from spirits, ready-to-drink beverages, and premium craft brands. These categories often grow faster than traditional beer and attract younger consumers with higher margins. To understand why Molson Coors stock significantly underperformed in recent years, we need to look at the key challenges the company faced over the last 5 years. First, the beer category itself has been structurally declining. Younger consumers are drinking less beer and shifting towards spirits, ready-to-drink beverages, and non-alcoholic alternatives. This created long-term volume pressure across Molson Coors' core portfolio. Second, the company faced brand and marketing controversies, which negatively impacted consumer perception and short-term sales. In today's environment, brand positioning mistakes can quickly translate into lost demand and heightened volatility in the stock price. Third, inflation severely compressed margins. Rising costs for raw materials, packaging, logistics, and labor hit profitability at a time when pricing power was limited. This led to weaker earnings growth and investor disappointment. Another issue was weak organic volume growth. While revenue sometimes grew due to pricing, underlying volumes remained under pressure, raising concerns about the sustainability of long-term growth. As a result, investor sentiment deteriorated. Molson Coors came to be viewed as a slow-growth, structurally challenged beer company rather than a growth or premium consumer brand. Despite the challenges of recent years, Molson Coors still offers several meaningful long-term opportunities. One key opportunity is premiumization. The company continues to shift its portfolio toward higher-margin brands and premium offerings, which can improve profitability even if overall beer volumes remain under pressure. Another important growth driver is non-alcoholic and beyond beer products. Demand for alcohol-free beer, flavored beverages, and alternative drinks is growing, especially among younger consumers, and Molson Coors is expanding its presence in these categories. There is also significant potential for margin recovery. As inflation pressures ease and pricing actions take effect, the company can rebuild margins that were compressed over the last few years. Additionally, cost optimization and operational efficiency remain a focus. Simplifying the portfolio, improving supply chains, and disciplined capital allocation can support stronger cash flow generation. Finally, Molson Coors trades at an attractive valuation relative to its cash flow potential. This creates an opportunity for investors looking for income, stability, and potential upside if execution improves. Let's now look at the key financial metrics for Molson Coors. Over the past 10 years, the stock has delivered a negative annual return of -3.6%, even after including dividends. This clearly reflects the difficult period the company has gone through, marked by declining beer consumption, margin pressure, and several company-specific issues. From a risk perspective, the stock shows low volatility, with a beta of 0.45, making it less sensitive to market swings. Valuation-wise, Molson Coors trades at an EV to EBITDA multiple of 8.8, which is below the broader consumer staples and beverage sector average. This suggests the market is pricing in limited growth and elevated uncertainty. Debt remains manageable, with net debt to EBITDA at 2.2, giving the company flexibility to invest and stabilize operations. Importantly, ROIC stands at 11.1%, indicating that the core business is still capable of generating solid returns on invested capital. The negative net income margin is largely driven by one-off charges, impairments, and restructuring costs, rather than a permanent collapse in the underlying business. At the same time, the gross margin of nearly 39% shows that the company still has pricing power at the operating level. Key takeaway: Molson Coors looks weak on the surface, but beneath the headline numbers, the business remains operationally viable, conservatively valued, and positioned for potential normalization. Let's finish with Molson Coors' dividend and overall investment profile. The stock offers a dividend yield of 3.9%, as of July 2025, supported by a low payout ratio of just 36%. This means the dividend is well covered by cash flows and leaves room for reinvestment, debt reduction, or future increases. Despite several difficult years, Molson Coors has maintained a disciplined capital allocation approach. The company is no longer chasing aggressive expansion but instead focuses on stabilizing margins, improving efficiency, and protecting cash flow. With low volatility, a reasonable valuation, and a sustainable dividend, Molson Coors may appeal to value-oriented and income-focused investors who are comfortable with slower growth and cyclical headwinds. However, this is not a high-growth story. Future returns will largely depend on execution, cost control, and successful brand repositioning rather than rapid market expansion. Final takeaway: Molson Coors represents a potential value and income opportunity, but patience is required and risks remain. If you enjoyed this analysis, don't forget to like the video. Let me know in the comments what stock or comparison you'd like to see next. And remember, this is not investment advice, just an educational breakdown.